Okay, the rules of debits and credits. Let's start with the different types of accounts and how they're increased and decreased. I made my own little spreadsheet here just to kind of show you, but the book obviously goes through this too. So a couple things about the rules of debit and credit. First thing, every transaction has at least two sides, which we've talked about repeatedly. But now that we're doing debits and credits, you need to understand that debits have to always equal credits when I'm journalizing. Try not to confuse a T account with journalizing. A T account is one single account, whereas when I'm writing journal entries, I'm using two different accounts and I'm debiting one account and crediting another account. And it could be multiple accounts, but I'm at least using two. And when I debit one account, I have to credit another account for the same amount. What that does is that keeps our accounting equation in balance all the time. So my debits must always equal my credits. If my debits do not equal my credits, I've done something wrong. There's no questions asked. This is one of the, you'll find in accounting not everything is black and white, but debits equaling credits is absolute and is black and white. Debits must equal credits in order for the transaction to be correct. Even if there's 15 accounts, debits still always equal credits in a single transaction. That's what keeps the equation balanced. Okay, so balance sheet accounts, rules of debits and credits. In the balance sheet accounts, we have assets, liabilities, and stockholders' equity. So assets are increased with a debit. The other thing about whatever increases an account type also is its normal balance. Now, its normal balance means, generally speaking, that is the balance that will be in that account. So back here, let's hold on. So assets, an example of asset is cash. It increases with a debit and it decreases with a credit. And so its normal balance is a debit. And you saw back here on this T account, the balance in that account was a debit. It generally would be. The only reason there'd be a credit balance in a bank account is if you were overdrawn. So debit balance represents that you have money in the bank. If there were a credit balance, which is not the normal balance, that would mean that you were overdrawn. So all asset accounts, everything that falls underneath the asset category, increases with a debit and decreases with a credit. So everything that is, all of these accounts here, all the same. Okay, now liabilities, on the other hand, are the opposite. Liabilities, normal balance is a credit, so it is increased with a credit. Sorry, liability is just these two. Increases with a credit and decreases with a debit. A liability account, if I had a T account for a liability account like accounts payable, like if I had one for AP, actually I got one up here, I guess I can use this. The expectation would be that no matter what numbers are in here, and they would come from transactions, they're not just randomly made up, but no matter what numbers are in there, generally, because its normal balance is increased with a credit, its normal balance is a credit, generally it will have a credit balance in it moving forward. Okay, so this one, for example, has a credit balance of 5,000. Generally speaking, a liability should have a credit balance in it. Stockholders' equity. Okay, now technically, remember, revenue and expenses are technically under stockholders' equity too. So stockholders' equity is increased with a credit and decreased with a debit, so its normal balance is a credit. And so if you see all these accounts here, increased with a credit and a debit for those two accounts. The only one that I just realized I mixed up is dividends is actually increased with a debit. Sorry about that. Decreased with a credit. I'll change my color coding too. It's an odd one out because it's in the stockholders' equity section. But what a dividend is paying out money from the stockholders' equity. So when I pay out money, that should reduce. So an increase in my dividends is a decrease in my stockholders' equity because I'm paying out for my stockholders' equity, which is why it's the opposite. Not to skip ahead too far, but expenses work the same way. An increase in an expense account means I'm spending money or costs are incurred. And so an increase in an expense account is a debit because it is a decrease in stockholders' equity, and stockholders' equity is increased with a credit. So it's got to go the opposite direction. Revenues, on the other hand, when I bring revenues in, those are an increase in stockholders' equity, so they follow the same rules as stockholders' equity does in general, which is an increase with a credit and a decrease with a debit. I'm not a big fan of memorization, but I will say this is so important. It's the one thing all semester you'll hear me use the word memorize for. So you need to memorize these rules of debits and credits. You need to know what increases an asset, what decreases it. And actually really only to one side because the other side is always the opposite. So if you just know the normal balance, what increases an asset, then you know that the opposite's what decreases it. Same thing with all the rest, liabilities, equity, revenue. If it, whatever increases it, the opposite side decreases it. It's either debits or credits. So assets increase with a debit, liabilities increase with a credit, stockholders' equity increases with a credit, revenue increases with a credit, and expenses increase with a debit. And I'll stop this video here, and we'll continue with the chapter in the next one.